Today is Wednesday, August 23rd, 2023. This is a special update video. There are a lot of things that are influencing the market these days. I talk about a lot of them on Mondays and even sometimes on the Friday videos. I want to dig a bit deeper today just for a short special primer on equity risk premium. One opinion. While this could get deep into the exact calculations and how we do all of this, I want to just touch on the surface and let you know what it is, why the rising treasury yields affect it, and some thoughts on how the past decade or so of investing may have an effect on how you're looking at this. So let's start with the source of this revisit. One that has been pretty quiet for years, came to light in the past year or so, the 10-year Treasury yield, and its move up. Following the decade of zero rates and very low 10-year Treasury rates, you may recall in 2020 when we went sub 1% on the 10-year Treasury yield. Overall, as we have been as we've seen the Fed funds rate increase by 500 basis points in the past 18 months, I want to talk for a moment on why the increasing yield in the 10-year is a headwind on stocks. This is one of those reasons, only one, for some of the recent weaknesses, the weakness in the markets. One way to explain this is the equity risk premium. Simply, this is the measure of long-term valuation for stocks in comparison to other assets. In this case, we're going to talk about the U.S. Treasury. Some say it is one of the better ways to compare the earnings generated by stocks to those of bonds if they were on a level playing field. Trying to keep it simple, we know that overall, in most measures, stocks are riskier and more volatile than bonds. So in this case, the equity risk premium is essentially the additional return that investors will expect to receive on that additional risk of holding stocks. This is trying to explain why anyone would buy any stock if you could just buy a U.S. Treasury for a little over 4% and take significantly less risk. Quick side note, there's obviously risk in all investments, and that is the important conversations we have when we talk about where you invest your money all the time when we talk. So overall, as the 10-year yield goes up, it has from about 3.75% about 4 weeks ago to a bit over 4.25% as we record this. As that goes up, the equity risk premium goes down. And the smaller that premium, the less enticing those other investments are. Now, there are a lot of other inputs to the equity risk premium, but the key is this. Why invest in equities and take the volatility and the risk if you can take much less risk, market risk, and get 4+%? This is why the higher rates are a headwind to equities. By many calculations, equity risk premium as of Tuesday was just about 1/3 of 1%. This is historically and obviously low. 1/3 of 1% is still 1/3 of 1%, but is it enough to pull cash from the 5% bank account or a 4+% Treasury? Normally, if it persists, the answer is no. I bring this to your attention to note why this is happening. The other thing is fair value on the equity risk premium is a moving target and is different for almost everyone. So here is the tales from the front line idea of the day, and then we'll close out. If you've been watching these videos long enough, you know that I have said more than once that if you're 40 years old or younger, you may believe that stocks can never go down. Well, the past few years have shown you that this is not true. They can. And the reason I bring this up is that it seems that today so many investors think that this equity risk premium is not relevant. This is not because they don't believe the math. They just don't believe that a 4+% risk-free rate of return, as they call it, in treasuries, and they don't believe that. And we did note that there is nothing that is risk-free. You just need to define the risks. But so many new investors think that the past decade of market returns in the zero rate environment is the norm, and thus 4% is nothing. This is something that you should understand, know what it is, and why it comes into play, especially with institutional investors. I'm not suggesting that 4% is the target, by no means. But as always, it is important to know your goals, know your risk tolerance, and build your portfolio knowing what that looks like. Additionally, for the other side of the story, the days of sitting and locking in a 4% rate of return, or what many find at 5% in CDs, and sometimes in that regard, is a good idea. I just want you to keep in mind that the prices you're paying for virtually everything you do, air travel, food, services, gas, cars, houses, the recent reports are about how the rate of inflation may be slowing. Let's just unpack that, and then we'll wrap up. The rate of inflation is still positive until it is deflation or disinflation. But if the rate of growth slows, it just means that your items that you buy are getting more expensive more slowly. They're still more expensive. This is the key input to the equity risk premium discussion. Is this small premium enough to bring enough money off the sidelines? As LPL Research wrote this week, the way this premium grows is math. Lower interest rates, improved economic outlook, and higher earnings. This is just a short primer video to dip into something that I think is coming into play in the markets. I hope it was helpful. Please keep watching the Monday market updates and the Friday planning videos. They're posted on my website, LinkedIn, and X, formerly known as Twitter, as well as emailed out. If you're not getting notice of it, please call Rebecca or send us an email. For now, have a great day. We'll see you on Friday.